I keep hearing the same comments about high income ETFs. It's the same in everything. NAV erosion, fake yield, tax nightmare. Look out for that tax bill, bro. Like all this stuff that is just like telling me that, what I'm doing is just terrible. So in this video, I'm going to break down exactly how Section 1256 contracts work in plain English. And I'm going to show you my real results. And I'm using QQQI and SPYI holdings. No theories, no back tests, just my real numbers. And spoiler alert, my QQQI and SPYI positions have grown in price and paid me double-digit income over the last 8 months that I've been holding them. And still, if people want to tell me that my portfolio is just eroding, definitely have at it. And if you want to see the tax, truth, and real numbers behind my investments, stick around. And I'm even going to address all the people are like, well, what about AIPI, Maggie, and FEPI? I'm going to address that later too. So that's what you're into, stick around. If not, that's okay too. I don't normally like making videos like this, but it's just consistent comments I'm getting about NAV erosion and that I'm going to lose all my money someday, which is fine. A great opinion to have, but I kind of want to address it. So here we are. Welcome back. Rico here. I'm a former creative executive who retired in 2023 and now live off of my investment income. I share my own portfolio, my wins, my mistakes, and everything I've learned along the way. So to be fully transparent. Quick disclaimer before we jump in, this is not financial advice. This is not tax advice. I'm just walking you through what I understand and what I'm experiencing firsthand. And you can do the research on these ideas and concepts yourself. You can hate on them yourself. You can love them. It's up to you. Okay, now let's talk about what's real and what's noise. QQQI and SPYI, both of these ETFs, they follow the same strategy and what we're going to base at least a lot of this information on today. They hold the underlying index for the NASDAQ 100 for QQQI and S&P 500 for SPYI. And they sell index call options on top of those holdings. Now, those options qualify as Section 1256 contracts, which come with two important features. So mark to market every year, those gains are treated as 60% long-term and 40% short-term. And I'll explain what that means fully in a minute. But for now, just know these funds are designed to capture upside, pay high monthly income, and reduce tax drag compared to other option strategies. They're not meant to be like rocket ships. This is not Tesla. And they are income producers, and that's exactly how I use them. So looking at some real numbers, I've held QQQI in this specific portfolio since May of last year. So everything I'm showing you reflects only 8 months of real performance. Before that, I was in another brokerage, and unfortunately that data didn't transfer over, or this information would be even better because my cost basis that came over from there was much lower than the one I'm showing you here. So even for those that say like, oh, the price erosion, I'm giving you an advantage here because my cost basis should actually be lower than it is because it just picked up the price from when I actually made the brokerage transfer. And the reason why I didn't do it, short, it's a bug, I guess, or downside of starting in Robinhood. Now I do everything in Fidelity. Okay, so look at the screenshot. So I own over 2,300 shares, which the cost base is about $120,000. So my cost per share was about $51, and the current price as of the day's recording is about $53, a little under $54. So my capital gain since opening this brokerage is $6,615, or 5.5%. And I've received over $10,000 in distributions and dividends. So my total profit since holding it in May is around $18,000. So in 8 months, my price is higher than my cost basis. I earned 13 to 14% distributions, and I'm sitting at a roughly 10.4% total return after 8 months. And that's not NAV erosion. That's not a melting ice cube. That's price appreciation and income at the same time. And some people may argue, well, QQQ is higher. Yeah, but I also am taking income. QQQ has like a 0.9% distribution. So I would just be watching it grow instead of living retired. Okay, now looking at SPYI, same story, same time frame, and just so no one thinks this is a QQQI only situation, here's my SPYI position. Again, I've also held it in SPY since May of last year in this account, but it's only 8 months. Remember, I was with Robinhood before. So I have around 1,500 shares here. My cost basis is just over $71,000. My cost per share is around $47, and the current price is just over $52 as the date of the recording. So my capital gain, this is just price appreciation, is over $8,000, and I've received over $5,700 in distributions. So I'm profiting about $14,000 or 19% in the last 8 months. In the same 8-month window, price is up, income has been paid, and nearly 20% total return. And again, not NAV erosion, not fake income, not a collapsing share price, just another NEOS fund doing exactly what it was designed to do. And someone who was able to retire in 2023 with over 6 figures in passive income. So that's just my experience. So let me explain what some people may mean by NAV erosion. So I'm going to do it in simple terms. So NAV erosion is the idea that a fund pays large distributions but keeps losing value over time because the distributions are just your own money coming back to you. And that's what people say NAV erosion is, right? That absolutely does happen with some products, especially ones that overwrite aggressively or use leverage poorly. Think yield max, right? But that's why I look at two numbers together. I look at the distributions and I look at the share price over time. If price trends down while distributions stay high, that's a red flag. But in my 8-month window, QQQI, price up, SPYI, price up, while both paid consistent double-digit income. And you can't call that NAV erosion with a straight face, right? Like if you're on there commenting, those are my biggest holdings, and you're commenting, oh, your portfolio is just filled with NAV erosion, I think you're missing the message. So let's get back to the 1256 contracts in simplified talk. So one, mark to market at year end, the IRS pretends the fund sold every open index option on December 31st and calculated the gains and losses. And this creates that tax treatment. And this 60-40 tax treatment, no matter how short the holding period, so 60% of the gains get long-term capital gains tax rates, which hopefully you know the benefit of that. And then 40% are taxed at short-term capital gain tax rates. And this is why these strategies can be more tax efficient than some people assume. They just think I'm getting a huge 37% federal income tax bill at the end of the year, which is so far from the truth. And why it matters inside QQQI and SPYI, because these funds use index options that do qualify for that 1256 treatment. And the income generated is taxed in that blended, more favorable way. So definitely do more research. I'm not going to make this whole thing about 1256 contracts, but if you want to do more, there's more videos on it. I would do some more research. But the question is, does it eliminate taxes completely? No, it does not. But if you get any income, Uncle Sam wants their piece. Does it help reduce tax drag compared to pure short-term option strategies? Yes, absolutely, because you're taxed at the 60-40 rate, not 100% ordinary income. But Rico, the tax bill will still be huge at the end of the year. I see and hear this a lot too. And here's how I think about it. I'm retired. My portfolio is my income. And anytime you earn income, you're going to have to pay taxes no matter what. So if you're working a W-2 job, you're paying taxes on your active labor every 2 weeks or however often it is you get paid. I'd rather pay taxes on money that shows up while I'm sleeping and then instead of paying taxes for working 40, 50, 60, 70 hours a week. And that's the whole point of income investing. And with 1256 treatment, not all gains are taxed as ordinary income. It's a blended rate. I bet you your income tax working at a W-2 job is all taxed at the same rate. It's all about your tax brackets, right? And this 60-40 treatment definitely helps. If you're still confused, think long-term tax treatment. So yes, I do expect a tax bill, but I also expect 13 to 14% income and price appreciation. And I'll take that trade every day of the week to stay retired. And so I don't have to worry about working anymore, right? And so I want to talk about how I use these funds. So I don't treat QQQI and SPYI as magic. They're just tools. For me, they're income producers inside a diversified income portfolio, positioned at a size I'm comfortable with, designed to pay me now while still letting me participate in upside. Could distribution change? Sure, of course. Could markets shift? Absolutely. But based on my actual results, price appreciation, strong cash flow, double-digit total returns in 8 months, these funds are doing the job I hired them to do. And I don't have the data because Robinhood won't let me. I had these funds, some of these funds are funds like this in 2022 that still generated income for me during that pullback. Okay, so I also want to address the folks that mention, well, what about AIPI and Maggie and FEPI in your portfolio? Those are yield chasers. Yes, absolutely. They are yield chasers. And that's what I have to say that they are. But they are there to generate income for me to reinvest in QQQI, SPYI, Devo, and other more core ETFs. Could I just go ahead and put that money straight into QQQI? Sure, but I'm making way more profit by using those higher yield funds, and I'm still holding them plus putting money back into QQQI. And if you're still skeptical, there's probably not a long enough video for you. So you can check out The Income Factory by Stephen Bavaria. You'll understand what I mean and how I'm using those funds to create more inventory to build my income factory. And this is definitely not your Dave Ramsey approach, if that's who you follow, or even your financial advisor who simply is just focused on growth. This is the factory approach. So if you're not convinced, there's nothing else we'll say that will convince you. But if you're more interested, definitely do some research on The Income Factory by Stephen Bavaria. Okay, so this is getting a little long, but let me just close this out simply. So the reasons why I do what I do: 1256 contracts, the 60/40 tax treatment, my QQQI positions, prices up, income's being paid, and I'm up almost 11% in 8 months. My SPY position, same thing, prices up, income paid, 20% in 8 months. No NAV collapse, no fake yield, just income and participation in upside. And yes, passive income comes with taxes, but so does active income. And it's not complicated once you understand how these strategies work. So hope you got value out of this. Thank you for watching. Please give it a thumbs up. Subscribe if you haven't already. It'd be amazing if you would share it with someone who needs it. I appreciate each and every one of you, even the ones who challenge me and maybe don't agree with it. I like them even better because you keep me on my toes. And if it doesn't challenge you, it doesn't change you. And as always, messy action is better than no action. And I'll see you next time. Boom.